Let's get back to the broader markets. Our next guest says that he likes stocks right now and thinks that equities are poised for a year-end rally. Joining us is Jeremy Siegel. He's Professor Emeritus of Finance at University of Pennsylvania's Wharton School of Business. And Professor Siegel, first of all, thank you for being here. Let's talk through your thoughts on this. Some people think, oh boy, we were due for a much bigger pullback. We've seen the pullback, and you think it's over. You think it's uphill from here, that equities prices are on the rise. Why is that?
Yes, let me tell you why, Becky. A lot of people say, look at how much bond yields, aren't they real competition now for stocks? First of all, stocks are selling for 17 times next year's earnings. If you take out the tech, it's like 14 or 15. If you go to small caps, it's 11. And I know there's reasons why, but those are very low valuations. But more importantly, why have bond yields risen so much? It's not just the Fed. It is faster growth than anyone thought. That's good for stocks. Promise of AI. The third quarter is going to be a real strong figure. And I don't see really any real weakness in it. But more importantly, and I think this is a major reason, bonds have been harmed by proving to be a very bad hedge against inflation. I mean, bonds are great hedges against geopolitical risk, against financial crises, but they're very bad against inflation. We didn't have inflation for 40 years, so everyone sort of forgot about that bond, bad inflation outcome. And then suddenly, after the pandemic, it reared its head. And when we look forward the next 10, 15, 20 years, people are saying, you know what? There may be more inflationary episodes. Do I really want to be in bonds? And we know stocks are real assets, just like real estate are real assets. And I think that's one reason why people have shifted. So bond yields, yes, have come up to be sure, but that's because they've been damaged as being seen as the ultimate hedge against stock risk.
Professor, let me ask you a question. Maybe I'm just not understanding this. If you think that there could be more inflation to come, that means that rates would go up even further still. And that's been a big issue. Every time yields go up on the Treasury market spectrum, you watch equities come under pressure just as people get concerned. And again, they look to this as being maybe if you think there's more inflation, that yields will go even higher. That's why bonds are a bad place to be. But ultimately, that could be bad news for stocks, too.
Well, I think actually inflation's on its way down right now. But Becky, stocks in the long run, and I've done all that long run data, are excellent long-term hedges. You're planning a 10-year portfolio, a 15, 20-year retirement portfolio. Stocks do beautifully against inflation. Bonds do not. So, yes, I think inflation is going down right now. But when we look ahead at the deficits and all the rest, could there be another inflationary episode? And then what do I want to hold? Do I want to hold real assets or do I want to hold paper assets? And Professor, I think that's one of the reasons why those yields have gone up.
You're 100% right, at least historically, that over, a 10, 20 or 30-year period, that is the case. The question that I'd ask is, let's say you're in a different situation and you're looking at your accounts and the balances matter for the next decade. Let's just make it a decade. What do you think then?
I would still be in stocks. I mean, you're talking about 10 years.
10 years. 10 years is the.
If I think there's going to be some more, I think rates are going to come down, but maybe 3 or 4 years hence, there'll be another little episode of, 6, 7, 8%. Do I want to be in paper assets? Do I want to be in real assets? Don't forget, we had 40 years. From, basically 1980 when we came down after Volcker all the way until the pandemic, where we really didn't have an inflationary episode. And that's one reason why bonds kept on going down, down, down in yield, because people said, oh, yeah, they're great hedges against, pandemics, but anything that you want except inflation. And people forgot about that. They thought the Fed would never let inflation go this bad. And now they're not as confident about that going into the future. 10 years for me is enough time. I want to be in real assets.
I agree with you. So I have a hard time arguing and playing devil's advocate in this, Jeremy. But let me tell you about a couple other arguments that have been thrown out just in terms of valuations for right now. there are those who say, look out, we are at very high valuations given some downturn that's expected to come. How much of what you're predicating your thesis on is that we'll have a soft landing and that there's not going to be a big downturn?
Well, soft landing probabilities have definitely increased. It's interesting. If we have a recession, yeah, I think stock prices will go down. But one thing has always been true. They go down too much in recessions, and they prove to be unbelievable buying opportunities. People get really scared, and then once that, and listen, we've gotten out of every recession the last 200 years. We'll get out of the next one, and then we see soaring. You're planning a 10-year portfolio? I wouldn't worry about a recession. If you're a timer and you think there's going to be a recession, yeah, I'd wait. But you have to decide what are you going to play that game or not? You know how hard it is to play that game. I rather, concentrate on long run. And as I said, 17 times earnings, and that's including all the tech, X-Tech 15, 14 times earnings, even on a long-term historical basis, is cheap.